Okay, let's officially go ahead and get started. Welcome to today's webinar, which is titled The Three Most Effective Strategies for Managing Your Retirement Portfolio. My name is Jim Penn. I'm the Manager of Retirement Services here at VectorVest. I'm very excited about this presentation. I hope you guys are as well. In fact, we're going to start off with some lofty goals. In this webinar, my goal is to show you that you can build wealth, transform your legacy, and live financially free. Now, those are some lofty goals for the presentation, but I want to show you that you can. I may not show you every tactic to get there in 45 minutes to an hour, but I'm going to do my best. I see a couple of familiar names in the chat box, and I want to introduce myself, give you my background. Again, my name is Jim Penn. I'm the Manager of Retirement Services here. I've been at VectorVest for about 16 years now. Since 1992, I've been in the securities industry. I started out as, I started out as a broker for about 15 minutes. That was back in the 90s, when they had the crazy boiler room stuff. I got my Series 7 and didn't last long as a cold calling stockbroker. But luckily, I knew the managers and owners of the firm, and they were kind enough to put me on the trading desk to start there and kind of assist the head trader. So I began there and ended up right before I moved my family down from the Connecticut, New York area. I was a market maker for a large market making firm up there until I decided that I was tired of shoveling snow. And so I moved my family down, and that's where I'm at now. And it's an amazing thing. I took my Series 7 in 1992, and how the markets have changed, how investing has changed. And even my philosophy since being here at VectorVest, how the outlook, especially of a longer term investor, should be. So I'm looking forward to our time together here. I want to walk through what we're going to go through quickly. We're going to talk about the VectorVest 3P investing model. We believe that every investor, especially retirement-minded investors, should understand and have access to. Next, I'm going to talk briefly about 7 signs that maybe your portfolio is not ready. I'm just going to go through that quickly. Then we're going to talk about the 3 core strategies. And first and foremost, we're going to talk about protecting your assets, preserving. We're going to talk about growing your portfolio and how to generate income. Okay, so we're going to talk about 3 different ways, 3 different strategies on how you can build, grow, and manage your portfolio. And then, as I said, John and I will be here for a live Q&A. We'll stay on as long as you guys have questions. I'll stay here and answer them with you. So again, if you have questions, type them in. John will answer what he can, and then remember at the end I'll answer any and all questions that we have. So let's go ahead and do it. Now, what I didn't mention is that before 1992, up in Connecticut, Norwalk, Connecticut, I was a cop for a better part of a decade. So if at any point it sounds like I'm telling you what to do, that's kind of where it comes from. Okay. It's never left me. It's when I talk about preserving your capital, I'll refer to that. But I am going to tell you something now. Turn off all distractions. Stay focused. Close your door. I know you're not going to turn your cell phone off. Put it on vibrate. Don't stare at it for the next hour. Okay. I want you to stay focused. I think there's some good stuff here you can learn about building and managing your retirement portfolio. Because after decades of working with retirees, VectorVest on its own, which has been around for 30 years, and my time here at VectorVest and in this business, here at VectorVest, we believe the retirement investing model that most people have been taught is broken. And we're going to offer you some minor tweaks so that you can get it fixed, so that you can get your retirement nest egg, your hard-earned net worth on solid footing. So that's my goal here today. Let's go ahead and jump in. The 3 Ps investing model. Okay. What we're talking about when we say that here is this is the model that we use, and it's proven to work. Okay. Hopefully you have a piece of paper, take some notes. You can draw this out with me. These are the 3 core pillars. Number 1 is profit. We talk about provide and preserve. These are the 3 Ps. Profit, provide, and preserve. When we talk about profit, and when you hear me use the the profit term. Think about growth, capital appreciation, right? The allocation of your net worth that you allocate to the equity markets to grow your portfolio. Very specific strategy and specific tactics that we use to do that. Next is provide income. So when you hear me talk about provide, think of generating a safe, consistent income. And we'll talk about two different ways to be able to do that. And then finally, and as I'll say more than a few times throughout the presentation, is the final P is preserve, right? Protect, right? Capital preservation. To me, of the three P's, is by far the most important of the three. You need to be able to protect your portfolio. Growing it, right, is really on its own. Yeah, it's great, but it's not helpful if you don't know how to protect it, because you'll just be spinning your wheels. Okay. So those are what we call the VectorVest 3Ps investing model, and then we'll break those down as we go through. What I want to spend just a few seconds on and is talking about some things that maybe why you're here today. I don't know, some things that may be affecting your retirement, just things to think about, okay, as we go through the three core strategies. One thing a lot of folks do is focus on Social Security to provide the income needed to retire happily. Just read a piece talking about 60% of current workers don't even think that Social Security will be around by the time they retire. And the amazing thing is, when you actually go to the Social Security website, it tells you it was never intended to be someone's sole source of retirement income. So right there, listen, it's helpful. There's a lot of people who've paid into it for years, and I'm not, I know it says trust the government, but listen, it's helpful, but that's not what we want to depend on for Social Security, right? The average check right now I read is somewhere around $1,700 a month, 6 to 17 grand, maybe a year, roughly, after you take out Medicare premiums. All I'm saying is it's not really, the best retirement plan is to simply count on that. Next, we talk about how a lot of retirees who aren't sure what to do save their money. Now, listen, it's wonderful to save your money, but stuffing it in a shoebox or under your mattress, or putting it in places that don't get you the. Now, listen, right now interest rates are at a level where there are some really good, safe places for, certainly for the short term, to put your money and grow it, and that's wonderful, right? Now, inflation has come off its peak as well, but remember, inflation will hurt the value of your savings. Okay, so we want to be smart about how we save our money, and not just, like I say, put it in a shoebox in our closet. Another thing that might show that your retirement portfolio may not be where you want it to be is that you just take that kind of set it and forget it. You have your money in a mutual fund, or in an IRA, 401k, whatever, and you're hoping for the best, right? The problem with just the set it and forget it is when the market drops 30 or 40% or more, many people will end up either delaying retirement if you're not already in retirement, or, as I'll talk about in a moment, people who actually have to struggle with the idea of going back to work when they really don't want to. So we have to be careful there. Here's where I know you got to be careful, right? When all else fails, you can play the lottery. The old saying, dollar in a dream. Whether it's you're investing, buying, some cheap penny stocks and hoping for the big winner, or actually going out and buying lottery tickets, right? Dollar in a dream turns into $10 or $20 a week, 50, a couple $100 a month. Listen, it happens, right? I think you guys know that that's not the best retirement plan to have. Now, I will say this is the caveat. I've been saying that last week I didn't win, but when the Mega Millions was 1.5 billion, we'll say that I did buy 2 tickets. But I won $4, so I got my investment back. But don't use it as your retirement plan. You may begin thinking about paying someone to make decisions for you if you don't already. Now, listen, that's not the worst thing in the world. We're not saying financial advisors are bad. They can definitely help in certain areas of allocation of your net worth, and there are some good, honest people out there. But you have to be careful where you get your information from. When it comes to your investments, right, at a minimum, we believe you need to be knowledgeable enough to at least oversee what your advisor is doing. Otherwise, you end up like our friend Rob here, who talked about the 2007, 2008. He had professional advisors during that time frame. They just told him, ride it out. Lost 40% of his portfolio, thought he was going to have to come out of retirement. It's not quite the dramatic drop in the portfolio here, but Carol also let us know that she talked about an instance back in early 17, or finally had the time to take an in-depth look at what the broker she had hired was doing. Now, what she did was she hired somebody to help with the inheritance after her dad had passed away. Right. And then she said when she finally had the time to realize what was happening, she was shocked. These are her words, mishmash of cookie cutter funds, right? 1% return when the market was doing much better. So that's the caveat when you're looking to pay someone else to do it. One thing is spending less. Listen, it's always good to be smart and frugal with your money, I suppose. But when you start spending less because you're worried about, you know, paying the next bill or whatever, right? If you're spending less for those reasons, not just trying to be smart with your money, then you might, you might check one of the boxes we're going to take a look at. And then finally, listen, there's nothing wrong with working in retirement or continuing to work, doing something you enjoy. But if you're back to work long, against what your original intentions were, then, maybe something's wrong. We have a quick checklist here called the Retirement Unreadiness Checklist. What I want you to do is type in the chat box for me if any of these apply. So in other words, if one of these apply, type in 1 of 7 or 2 of 7, 5 of 7, whatever it might be. I'm going to ask you throughout the presentation to interact with me. So if you can, maybe 0, right? A lot of folks, when I do this little poll, will type in 0. That's 5. That's fine. So how many check marks did you put on this little list here? Liliana says none. Good. Michael had 5. Man had 5. I don't know if that means 5 checks or number 5. If that's 5 of 7, you're definitely in the right. Michael put a none down. David, there's a great answer. David says none, thanks to VectorVest. Dwayne says number 7, decided work part-time. Yeah, well, Dwayne, that's a great point. Dwayne said work part-time to keep your mind active. Okay. Which is great, right? Doing something, you want to do because you feel like it or you feel like you can. That's wonderful. But when you get to the point where you feel like you have to do it, that's what we don't want to happen. All right. Great answers. Thank you guys for interacting with me. So if you did type in any of those or check them on your check box, right? What we say, it's just an indication that you need to take more control of what you're doing. That's the purpose, right? We want you to have this idea that, this strategic shift, as we call them. We'll talk about a few of them as we go through, right? So the strategies we're going to talk about will give you, the techniques to manage your own money. And if you're paying someone, again, which is fine, maybe they're watching some of it for you, but you'll have at least the knowledge to look over their shoulder and say, hey, what are you doing there? All right. With that, let's go ahead and jump into the 3 Ps because I believe it is the most important. I'm going to start with capital preservation or preserve. Okay. This is my attempt at humor when I tell you I was a cop a long, long time ago. I took an oath to serve and protect, right? Protect and serve. Those, I took an oath and I still like to live by that oath, only now it comes down to your retirement portfolio. Okay. So I want you to be able to protect your assets first and foremost. Okay. Instead of worrying about the market, falling, wiping away chunks of your nest egg, you need, for those who remember the old Reagan era strategic defense system or strategic defense initiative, I believe it was, right? We're going to look at it that way, right? How to be strategically defensive. Because a lot of people get caught by surprise when the market falls. And after it happens, you hear, the people on TV and advisors talk about, they tell you what you should do now, right, to try and make your money back. They're not around to tell you what to do before or as it's happening. So we need you to be protective. So what we look at it as simply you're insuring your portfolio, right? You insure your home, your car, your life, your health. I always laugh. My wife and I, we have insurance on our dogs. Two dogs have insurance. So the key is you need to know how and when to insure your portfolio. So what I want to do here is take a couple of minutes and talk about market trends. How you need first and foremost have to have the ability to recognize when it's time to become defensive. So what I have here is, here at VectorVest, we have a very long historical footprint here, and this goes all the way back to 1999. This is what we call a market timing graph. This is the VectorVest composite and index, very broad index of the overall stock market, right? And a very long look back. So I want you to interact. I'm going to ask you a question I think I know the answer to. Have you ever bought or owned what you believed was a really good stock and watched it drop when the market dropped? If that's the case, type yes in the chat box. I know the answer. We've all been there. I've been there. Do it less than I used to, but sometimes it still happens. Michael, Liliana, another Michael, John, Dwayne. Yeah. Thanks for interacting, guys. Yeah, it definitely definitely happens. What I want to do is zoom in on a few of the biggest market moves that really hurt a lot of folks. So again, I believe it's important to recognize these trends and how you can recognize them. So that's where we're going to take the time to do this. I'm going to guess again that there are people in the room here today who did experience the bursting of the dot-com bubble, right? We had a client, Lynn, his name is during the dot-com, he took 80 grand and increased it 5 to 6 times. But in 2000, when the market turned over and the bubble burst, he proceeded to lose almost everything over the next 2 years. And these are his words, he was not happy. We believe that happens way too much. You're able to take advantage when the overall market is rising. It's wonderful. Rising tide lifts all boats, right? What do you do when that starts to turn against you? How do I recognize that? And what do I do when it does? Right? You make money in the uptrend, but if you don't know how to protect it, like I said earlier, that's why preservation is most important. Capital appreciation is wonderful. But if it's only on paper and you give it back, it's not very helpful. All right. Here in 2008, everybody remembers that, I'm sure. When the housing bubble burst, the financial crisis, all that happened there, the average mutual fund fell 40%. And as we saw Rob earlier, talked about his portfolio going down, thought he'd have to come out of retirement at that. Then we fast forward to the COVID downturn. Now that downtrend, of course, was a much quicker downward movement in for the market, but the S&P did drop 34% in a very short time. Now, what I'm going to show you has even how the VectorVest program recognized that and had you prepared even for that when most folks were in what's going on. Okay. And then we look back from the bear market that we saw from November of 21 right through October of 22. We know the S&P again went into bear market territory, dropping over 30% during that time frame. Let me ask you guys a question. Did your over any of these times, and there are others, by the way, these are just 3 obvious ones. One that's left out here is January of 2018. It was very short term, but an eternity ago now, I guess. But that was another one. Did your financial advisor ever call you leading, if you have one, up to any of these events? Did they ever call and say, hey, we got to become defensive. We ought to be thinking about, doing whatever we have to do to protect our assets and the gains that we have? If you had one, did one ever call you and let you know? Right? Dell says no. Michael says no. Man says yes. All right. Well, man, that's one that you want to keep around. As I said, I'm not out to, show my disdain for money, man. It's not really my point here at all. It's to educate you so you can work with them, not just count on them. Michael says no, and I fired him. Dwayne says, COVID caught me and I panicked and sold at the bottom. after the fact made a mistake but was nervous. Yeah, Dwayne, I'm going to show you how VectorVest, I know it doesn't help much in hindsight, but moving forward, we want you to be able to recognize these times, right? So again, thanks for interacting. See, the key here is what we need is a system. Whoops, I'm sorry. What we need is a system that you can count on that allows you to determine the market's direction. Okay, the trend. Some people use things like moving averages on the S&P. I use VectorVest. Okay, I use VectorVest. I wanted to just comment on something real quick here as well. Right, there are a lot of people who say that you can't time the market. Right, and those who say it are right. They can't because they don't understand the process or don't have a technique to do it. Right, the truth is you can't predict where the market is going. But to tell me you can't time the market means you don't believe in any technical analysis of any sort on any stock or on the market at all, which I doubt the people who say you can't time the market believe. What you can do is analyze what's going on in the market. You can recognize trends and act on those trends. Going to be 100% every time? Absolutely not. You're going to catch every tick at the bottom or the top of a market move? No. But you recognize the trends, you follow that trends, and the probabilities keep you on the right side of the market. Okay, so let's go ahead and keep going through here. So what I want to do is just show you what it's like when you have the proper guidance. Remember, first step, the biggest step is understanding when to be defensive and then how. That's the purpose of what I'm talking about here. Let's start with, and we'll just go back to 2007, 2008. Back on November 2nd of 2007, this is just off a market peak. That's an all-time high in the VectorVest composite. We wrote to our customers, we wrote the confirmed down signal that we received. That's a VectorVest proprietary market trend indicator. It was the confirmed down. Could be the entree to a long bear market. So don't be deceived by endless parade of experts who will appear on TV and other places telling you to buy stocks. It's not the time to buy stocks. Okay, that was our guidance right here. So you can type in yes if you feel like it, but write it down. Ask yourself, would that have helped you if you were fully invested in the market in November of 2007 at an all-time peak? Let's take a look. As I said, even on the pandemic, understanding market trends and having information to recognize those trends is super important. This was our Valentine's Day gift to you on 2/14. Just days before that peak. Again, another all-time high in the VectorVest composite and on some of the major indexes, right? I'm not going to go through exactly what the bearish divergence was, but our timing indicators told us this in our strategy section, that the bearish divergence that we saw suggests that downside risk outweighs upside potential. Downside risk outweighs upside potential. That's pretty straightforward, pretty clear guidance, I would say. That was before we really knew what COVID was going to do and what that initial panic was going to be about. A week later, we also said in our strategy section, prudent investors should not buy stocks. Aggressive investors and traders should play the market with a bias to the downside. A week later, or a week or two later, again, prudent investors should not buy stocks. Play the market to the downside if you're in. And then finally, we got our signal went to a confirmed down situation. This is the proper guidance that you need to understand. And listen, I don't want you to just be providing insurance policies for no reason. You have to understand when the most important times are. So that's what that does for us. And then once we know when to do it, now what do we do? Michael, usually I wait till the end to do this, but Michael says, how many false calls have there been? I don't know that I'd call it a false call, right? We're not predicting, so it's not a false call. right? We're recognizing a trend. We're using a process and a technique to raise the probabilities of being on the right side. I can guarantee you, you would lose a lot more money not ignoring the calls. Okay. Can they whipsaw? Of course. Of course they can. So when I talk about, which is a good segue for me, when I talk about insurance, I'll ask you about I use car insurance as the best example that I can use. Car insurance. I use Geico. I ACH automatic, payment every month. Once a month I open up my account and make sure everything got through. Right. When I look and see that I just paid Geico for my car, my wife's car, and right, I want you to think of it this way. I don't get mad because a tree didn't fall on my car this month. So when I go in and I do what I'm going to talk about here in a second about protecting your money, and it's putting a trade on to do it. The trade is there for insurance, not to profit or to it's a different mindset. So keep that in mind as I go through what I'm about to go. Okay, that's the idea. Think of it that way. You pay car insurance. The tree doesn't fall on your car. It doesn't make you mad that you didn't need to use it, right? Okay. With that in mind, let's take a look. This was throughout 2022 when the market really had a rough year, right? Let's talk about what you could do, what you could have done then, but more importantly, to illustrate what you could do in the coming when the next market trend is telling us to be defensive. So these are actual trades I'm going to share with you. These are actual trades where we got a confirmed down, okay, knowing that from November of 2021, this market was clearly in a downtrend. Okay, I could use any of these. I'm using the April one. These are trades we actually did in our retirement coaching group with live money. So these are actual trades. I'm going to zoom in on that time frame. So our coaching group meets every Tuesday. We got the confirmed down. The next time we met in the coaching group, we went out and bought. I just illustrate buying one SPY put option as an insurance policy for a portfolio of between $40,000 and $50,000. Now, for those who might be new to options, first and foremost, I'm not going to spend time I'm not teaching options right now, but if you're going to hear me talk about two option trades: a covered call and a protective put. They're not difficult. You don't need to be an options expert to do it. If you're building and managing your hard-earned money, I think they're something you have to have the ability to do, in my opinion. Okay. So when you buy a put option, it gives you the right to sell 100 shares of the SPY ETF, which means simply that when the SPY or the S&P 500 goes down in price, as we see here, the value of your put option goes up. So that's $9.03 per share for one contract, which gives you the right to sell 100 shares of SPY. Okay, so that's just a quick lesson on what it means. So on this particular day, I bought one put option. Now, as it turned out, again, these are live trades based on our risk management techniques. A week later, a few trading days later, we closed the insurance for a profit of $1,234. Okay. Now, again, there's a process and a technique behind what we did, but as you'll see, I bought more. But this one, we pocketed that. Oh, remember, what's insurance? It offsets damage to an asset. So our portfolio may have been ticking down a bit, but we're able to protect it with what's called a protective put option. Mitigate the losses. Not too long later, on May 10th, we did the same thing. This time they're at $15.38 per share. This one held a little bit longer. The market came down, moved up a little bit, not too much. But on June 14th, we closed that trade again for another $1,000 or almost $1,100 of money. to offset what the market was doing. In September, we did it again. I bought two put options. I bought the right to sell 200 shares of SPY. This one cost $2,198 for two options. Again, just 3 days later. Market, as you can see, those are big moves, by the way, $20 increments on the SPY. We were able to pocket over 100% gain again, another $2,200. And then one more time in 2022, we did it again, another over 100% return. So it was a tough year. And again, this wasn't trading for profit. This was protecting equity portfolios that had positions and were being managed. So John says, when do you know when to sell the put? We do have risk management techniques that we put in place. I can give you an idea of what I do. There's the technique that we use. We use a 50% stop loss and a 50 to 100% gain is where we take action, whether it's sell some of them, close the trade, take the profits. So there is a process to it that we use. Now, one of our customers, Elaine, was kind enough to shoot me an email. This going back a little ways. This was that January of 2018 I was talking about. He said, Jim, because of your teaching, I hedged my portfolio with puts on the SPY, saved his portfolio for a very small investment. He held on to his. I was trading mine. He held his through a very big, wasn't long, but a very big downturn, and was able to protect his. So how much would your portfolio insurance have benefited you? Right? If you had that there while you're typing that in, do you think that would have been a benefit? Dwayne types in the question we get every time. We made about $6,600. How much did you lose in capital during these drops? Well, Dwayne, it was just under $50,000 portfolio. I don't know what the exact loss was. It was being traded. There were cover calls being sold, stocks being sold out as well. But if we had think of it this way. And I don't think it wasn't that much, but let's just say there was a 20% drawdown in the equities that I made. Right, $6,600 on a $40,000 to $50,000 portfolio is what? And use my public school math, but $5,000 would be a 10% gain in the puts, right? So 6,600 is what, 12, 13%, 14? I don't know. Our other risk management techniques would have had the overall portfolio down maybe 15 to 20% tops. That's what I was saying earlier. When you do nothing, you get 40, 50% of your portfolio wiped out. You just set it and forget it and don't know what to do. So if I could lose 8% or have the drawdown of 8%, not even a loss, right? It's still just the drawdown because I was able to insure my portfolio. May not be dollar for dollar. Okay. So there's a strategic shift there that I talked about, right? And that means going from worried and unprepared and not knowing what to do to being able to defend, protect your net worth. It's a huge, huge important factor in our retirement model here. Okay, from here, I'm going to shift gears. I'm going to shift gears and I'm going to go to profit. And I'm going to talk about growing your portfolio. Okay, now that we know how to protect it, we at least have an idea of understanding to recognize using whether you use technical indicators, if you're a VectorVest subscriber, if you're not, we have a great way of recognizing the different trends in the market. But now that you know there's at least a way to do that, it can change the way you invest and try to grow your portfolio because you don't have to be, ultra conservative anymore because you know what to do. And then having a technique for the portfolio for growth too. So we want you to be able to take full advantage of upturns in the market. So how do we do that? Well, for us, what we do here is we buy safe stocks rising in price in a rising market. Okay, that's our VectorVest mantra, buying safe, undervalued stocks that are rising in price in a rising market. Okay, that's our goal. When we do this, we focus primarily for the retirement-minded, more prudent investor on a stock safety. Because while it's fun to hit a home run, I'll use baseball analogies several times here, but if there are any baseball fans out there, what does a home run hitter do when he doesn't hit a home run, especially in this day and age in baseball? Wasn't always the case, but when a home run hitter doesn't hit a home run, what does he do? Right, he strikes out. Right, that's what happens to the home run hitters. Well, striking out is not an option for us in our retirement accounts. We can't afford to strike out. Shouldn't be striking out. You want to allocate money to be speculative or aggressive in the market? By all means, go right ahead. What happens is when you can end up trading, you try to hit the home run and start trading to make up for any losses, right? You end up investing in a way that's not fit for you, right? If your objective is to build and manage safely and steadily growth and income in a retirement portfolio, just because you didn't see a market trend coming and you lost money, the idea is not to go in and trade it, all of a sudden becoming a day trader to try to make it back. That's not what we want you. Makes me think of teaching my boys. They're older now. I got two boys, and when they very first got behind the wheel of a car and they struggled in any sense, I didn't tell them to, you know, smash the gas pedal to the floor. You wouldn't tell your kid to do that if they were struggling learning how to drive. Don't do it in your investing. Don't try to get it all back if you have a rough. Stick to the process and the. So it starts with a quote our founder and mentor, Dr. Bartolito, has said and written many times. Good portfolio management starts with buying the right stocks. Starts with buying the right stocks, right? I always again use the baseball analogy or any sport that you want to use, right? You want to have a winning team. How do you do that? You put the very best players on the field, court, on the ice, whatever sport you want to use. Right? You have a team of the best players, and that's when you're going to have a winning team. Same thing with a portfolio. You put the best stocks in your portfolio, and that's how you're going to succeed. So what we look at here at VectorVest, as I said, we focus on safe stocks. These are just some of the factors. Excuse me, I'm sorry. These are just some of the factors that we take into account when we're looking for the safety of a company that's worthy of being in our retirement portfolio. So we talk about earnings consistency. Does the company make money quarter over quarter, year over year? How big is the company, right? Just because it's a large company doesn't necessarily mean it's safe, but we take that into account. Excuse me. Price volatility, right? We look at graphs. Does that company have a long history of violent moves? Debt to equity ratio, simple things on the accounting front. Is the company strong enough to withstand any kind of headwinds that it might incur, whether it's specific to the company or to the overall economy, whatever it might be, right? Every company at some point is going to run into these headwinds. Do they have strong enough balance sheet to be able to overcome that? Again, how long has the company been around? The dividend history. Good, safe company doesn't have to pay a dividend, but if they do, they darn well better keep paying it because, as Dr. D has written many times, there's no worse black eye for a company than to have to cut or suspend their dividend, right? Not a good sign. So all of these factors come into play. So what I want to do is just take 2 minutes out, and I'm going to jump into the VectorVest program. Try to it. There we go. I'm in the VectorVest program here, and what I wanted to do quickly is just give you a quick visual. It's just I'm going to do it's called a quick test, right? Just to give you an idea of the power of relative safety. So I go into my viewers tab, what I have done here, the name of the watch list is actually 40 well-known companies. 40 well-known companies. These are companies that you're familiar with. Pretty sure if you invest in the markets at all, or not even invest, you don't even have to invest. You know these names. Companies where, you shop, you eat, where you drink, where you spend money. And I chose these um, and to make a point. Now, these are not just randomly in order here. They're sorted by VectorVest flagship indicator for analyzing stocks is the VST. It's the value safety timing indicator within our program. What I've been talking about is relative safety. And we define as the consistency and predictability of financial performance. What two better words to describe the type of stocks in your portfolio than consistent and predictable? So that's what we're talking about. So here's what I want to do. These 40 stocks that I'm sure, familiar with, you've spent money at before. I want to do a couple of quick tests. I can change the date here. I'm going to go back to a date and time a couple of years ago, and it's just to show you in up and down markets. 2021 up until November was a good time in the market. We've had up and down trends here. So I want to show you over that time frame. This is what the list looked like back on January of 2021. I am going to sort this list. Okay, I just click on the header there. I can change the sort. What we're looking at right now is the same list of 40 stocks with the lowest on a 0 to 2 scale, by the way. The 0 to 2 scale, these are the lowest ranked relative safety companies. Now, I have the ability to click right here, and I can take the top 10, and we can look at the performance. No money management, point A to point B. That's all this is, and how they performed. These are low relative safety stocks. Now, over the roughly 3.5, almost going on 4-year period, this list is up 4.5% versus the S&P 500, which is up over 21%, almost annualized. That's buying low RS stocks. Well, I click on the button. Now I have the same 40 stocks on that date, and I now have the highest relative safety indicator. Let's quick test those top 10. And you can see it's moved right step with the S&P 500. Again, no money management techniques, no stops, no nothing. So right there is the power of relative safety. Let me take it one step further. That's only 40 stocks that were chosen. Now we track over 9,000. Back on this date, I can take, at that time it was 7,300 stocks. We're now over 9,000 stocks. I could take the same list and we're still sorted by relative safety. Again, no money market techniques. If I quick test those, we see that that's a significant better return than the S&P 500. Again, no money management techniques or anything. Just a quick way for me to illustrate, especially for those who may not be familiar with VectorVest, the power of relative safety. And when you add in, the ability to manage those positions, it really does come in handy. So I just wanted to share that with you, just get you in the program to see what that was all about, and understand the power of relative safety and the power of being able to sort them within the VectorVest program, right? So we have portfolios that are currently up. They've had some drawdown. In fact, you know what? I'm going to take 2 seconds and share those with you. Oh, I don't go back. But we have portfolios, again, that we manage, blue chip. I didn't even get the dividend payers yet. This is a 10-year-old portfolio. We're averaging with dividends over 18% annualized rate of return. This doesn't include the dividend. This is just capital appreciation. Our growth portfolio, okay, it's up nicely today. Did it take a drawdown? It sure did. But our protective puts and selling covered calls didn't cover it dollar for dollar, but it did help. Even with that drawdown, this portfolio is up just about 24% on annualized rate of return. 24% annualized rate of return. This one's over just going on almost 6 years. That's using protection. That's using a proper technique. You don't think either 18% or 24% is a good annualized rate of return for a prudent portfolio? I need you to give me a call so we can discuss that. So the idea here is another strategic shift that we want to talk about. So going from, spinning your wheels, not growing your portfolio properly to where you have a solid growth portfolio strategy that has you buying good, safe stocks at the right time so you can grow your portfolio. And then of course it goes hand in hand with the ability to protect them when those drawdowns. Again, we're looking to build wealth, transform your legacy, and live financially for all the steps that which finally brings me to our it finally brings me to generating income. Okay, where we're going to talk a little bit about two different ways, two different streams of income. John typed in, does blue chip dividend percent also include dividend payments? Um, no, that number I showed you on the portfolio was just capital appreciation. When you add the dividend payouts, which I did in a different spreadsheet, it's 18% return. And that doesn't even include, by the way, I'm going to talk about dividends now, just so you know, that doesn't include reinvesting those dividends, but you don't have to do if you want to use the money for something else. But if you reinvest them, it gets you up over 20%. So the goal to generating new income is opening up new income streams, right? Plural here. First thing I'm going to talk about is getting paid with dividends and how you can use VectorVest to do that. Right? Everybody knows about dividends, but really finding the best dividend paying companies for a lot of people, it doesn't always work out well. Okay, a lot of folks will go in and just Google, you can do that now. When we did this screenshot, 71 million hits on good dividend stuff. You can go get information. What'll happen is oftentimes it'll talk about the yield, the dividend yield of any particular underlying stock. What it won't talk about is the quality of the company, right? So what a lot of people do is make the mistake of chasing high yielding dividend stocks without any concern of the ability of the company to, first of all, pay them or continue to pay them, or for the company to have, what good is the dividend if you lose 20% in capital? So what I have here is just a screenshot of, we call our watch list viewer. These are our dividend payer searches. See, we have a bunch of different ones. I come right to called the DRIP 25 plus. The DRIP means dividend reinvestment plan. So if you choose to, the dividends can be automatically reinvested to grow your positions. And again, that's an amazing compounding of good dividend portfolio. And you don't have to choose to reinvest them. You see even better returns. So what this list is just simply 125 stocks at that time of companies that have not only paid, but have grown their dividend every year for 25 years. Similar to what you might have heard the dividend aristocrats. The difference is in dividend aristocrats, it has to be a S&P 500 company at the time. Some of these were, some of them are not at this time, but that's a list of showing some good quality companies, right? So we look for companies with a good history of paying their dividends. Proprietary indicators that track dividends. Here's one. This is 1997. This goes back 26 years. This graph, weekly graph of a stock that was on that DRIP 25 plus list. And what you have on the bottom here, this is the dividend payouts, right? What I like to call the golden staircase. We used to have a talk we did a long time ago. I pertain it now to dividends. That's what we're looking at. A company that continues to grow its dividends. Why? Because they're able to continue to grow earnings. And when you can do that, you'll see the price of the stock also over time continues to rise. All of these things go together. Relative safety, strong dividends, safe dividends. They're all go here. So this is a portfolio. This is not, I showed you the current view of this. Again, this was the pandemic drawdown. So there's been some drawdown. I can live with drawdown on a dividend portfolio because the goal really is consistent income that comes from it. But again, this does not include the dividend growth to that. So very important to understand the takeaway there is the quality of the underlying stock, the ability to not just, say, okay, well, that stock's yielding 14% dividend yield. That must be the best dividend payer out there. I can tell you from experience in my time here at VectorVest and before, that's not the way you want to go about building a good quality dividend. The second spot, John, you can answer Henry there, or you can flag it and we can talk about it in Q&A. It's a good question, though. The second part of generating income is collecting rent from your stocks. That's the way we phrase it, right? To do that, you'll use one of the safest option trades that are available, one of the most popular, one of the easiest and most popular option income trades that there are. And it's called selling covered calls. Selling covered calls, meaning that you own an underlying stock. You're selling someone else the right to take that stock away from you at a higher price. Let's take a look at what, for those who may not be. So here's an example. There's a stock. It's trading at $47 per share. Either you already own it or it's called a buy right, where you simultaneously buy the stock and sell a call option at the same time. So you either own or you buy the stock at that $47. For those who may not be familiar with covered calls, here's what a covered call is. This comes from a gentleman named Lee Lowell. He wrote a book Dr. Delito recommended to us here, and he gave the best definition of what a covered call is. And it simply is the fact that someone will pay you money today for the right to call away or take your 100 shares at a specific price, at a higher price, at a future date. You're selling, someone's going to pay you to take your stock away at a higher price at a higher. Now, sounds pretty good to me anyway. Let's take a look at what it looks like. This example, by the way, it was another actual trade that we did in our portfolio. We own the stock at $47 per share. We sell someone else the right to take the stock away from us at $49. And they pay us $2.27 per share, or 227 bucks. Now that money is yours. They pay you to do that. They paid us to do it. Now, how much of it we get to keep is going to depend on what happens during the life of the trade. Once they pay, right? So what does that do? Not only does it go into our account, but it also lowers the cost basis on this underlying stock. So it's for one contract or 100 shares, it's $2.27. So help me with, again, my public school math. That gives me a cost basis on this stock of $44.63. Right? That's where I own the stock now, $46.63. The stock could, I'm sorry, $44.63. That's where the stock could go. So let's look at what could happen when you place a covered call. So the profits from the call option that you took in, they build a cushion, meaning that now the stock, like I said, could go down to $44.63 before we lose a penny on this trade. That's why their covered calls are also great for selling against stocks you already own in a toppy market. So you would always have risk management techniques on the underlying stock, because that's where your risk is, the fact that you own the stock. That's why for a long time, the only trade you could make, the only option trade you could make in an IRA was selling a covered call. Why? Because it added absolutely no risk to the trade. You long a stock, that's where your risk is. In fact, your risk is Okay, what if the stock goes sideways? Well, that's fine too. You get to keep the 227 bucks. Plus, you can sell another covered call against the stock, lower the cost base even more. You get to keep that entire premium. If the stock takes off, it's the best case scenario because now you can make the max profit. In this case, you would have gotten to keep the $2.27 per share plus $2 more in capital appreciation. That's if it goes up and at expiration, would be called away from you. You would make what's called the max profit. Remember, the objective of doing this trade is to generate income. What happened in this actual trade? The stock went up slightly. It didn't take off, but it went up enough where we closed the trade following our process and pocketed in less than 1 month 304 bucks. So I forget the exact percentage that came to, 6-7% maybe in a month. What if you had a monthly dividend payer that paid you 5 or 6 or 7% a month? Really good, right? So it's another great way to generate income. And of course, there are tactics that go along with the strategy. Jerry here, one of our students, these are his words again: hit or miss with no methodology. That's how he tried to trade covered calls, going to a consistent monthly income over 2% a month. So I'll ask you guys, what would extra income allow you to do? Would that be helpful as you either plan for, or I know a lot of you typed in that you're already in retirement? Right? Safe, consistent way to generate income. What would that do for your retirement? Now, that's our next strategic shift, right? When you implement the provide piece to your retirement investing model, you'll be able to shift from not having enough income to where you have a steady flow of consistent, which will allow you to continue, again, living the lifestyle you had planned for. Does it mean you have to do, both dividends and covered calls? You may not. Further you get into retirement, you're going to want to make sure that, your dividend portfolio is strong. You're getting both capital appreciation and income. So you allocate throughout these different core strategies. So I believe you guys are here for a reason today, that you took the time, and I'm so glad that you did. Stay with me. We're going to go a little deeper and answer any and all questions. You may be here because your portfolio pulled back through 2022, late 21 and 22. Maybe even though we've had what I call kind of the sort of rallies, maybe you're looking to get it back on solid footing. Maybe you're here because of income. Maybe you're looking to replace the paycheck that you're no longer getting in retirement, above and beyond Social Security. So maybe there's not enough income and you need to put a new faucet stream. Maybe you're here because you feel you might have to scale back in retirement, or worse, rely on others. Listen, maybe you're well, maybe not exactly where you want to be, but maybe you're doing okay. Maybe you're just not quite where you want to be. But you don't have a plan to get there. What can I do to get there? How can I put this all together? So we mentioned earlier, it's taking control of what you can control and show that it is possible as long as you have a clear plan. And that plan included the strategic shifts. So we talked about defending, protecting your portfolio, understanding how to do that beyond just stop criteria. We talked about seeing growth, buying safe, undervalued stocks that are rising in price in a rising market. When you do that correct, that's what we're looking for, steady growth portfolio. And then finally, how you can generate consistent income with new income streams using good quality dividend portfolio along with. So the main thing I hope that you learned today is that the secret to building wealth, transforming your legacy, and living financially free is really found here. It's to make sure that your retirement investing model includes these three core strategies of profit, provide, and preserve in some form or fashion. That's the foundation. That's the breakdown. Protecting your net worth, growing it, and using it to generate income. So that brings us to a question that you should be asking yourself. Not that I'll ask you, but you should. How do I create this type of system in my retirement portfolio? How do I do that now to take advantage of the process and the technique? Well, I believe, anyway, I believe that you have a choice. I believe you have a choice, right? First choice is you can choose to do absolutely nothing, keep doing exactly what you're doing right now. But we know what happens, same old thinking, same old results. My fear is that you'll be in the exact same place you are next year, the year after, worrying if you'll have enough money for retirement. Again, be able to take control. You can choose to do it alone. Maybe put some of the ideas here, some of the other things you read or hear, here or there, wherever you might be looking to improve. You could learn by trial and error, as our struggling carpenter here. It looks like he tried trial and error. What happens when you keep making those mistakes? Or you can choose to do what Jerry did, what thousands of others have done, and that is to get right to the solution, right? Why do all the work on your own when there's training available that allows you to bypass all that trial and error and get to success much faster? Instead of taking the long way, right? Unfortunately, this seems to be the road less traveled by many people. Stay off this troubled highway here. Learn to take the shortcut. Get your retirement on solid footing as quickly as possible. So what I want to do is offer you a plan that if you and I were to work together for 5 weeks, literally you and me in a room every week for the next five weeks, here's what I would get you to do. What I'd get you to do. It is a retirement portfolio transformation. It's a step-by-step roadmap to a secure retirement. Stay with me. I want to talk about the foundation of that, how it works. Um, First thing, before I get into that, I want you to understand something related to what Albert Einstein said. Everything should be made as simple as possible, but not simpler. The point of that quote is that this is not some get rich quick scheme. It's not something that you take some magic pill for and all of a sudden you're going to double your portfolio. And it's serious, requires some effort on your part. But if you put that effort in, I believe you're going to see the results. This is why VectorVest created and why we have put together, was created in the first place, why we put together this retirement portfolio transformation for serious people who want a simple plan to set up their retirement portfolio for success. By transforming your portfolio, you'll be able to reach those goals of building wealth, you, your family, transforming your legacy and creating a better life. Your children, your grandchildren can have that financial. So again, it's called the retirement portfolio transformation. You'll give me just a couple of more minutes. We'll answer any and all questions. I see a few that are coming in. Um, Give me just 2 minutes. The easiest way for me to do this is explain the course. I'm going to map it out for you, and we'll go module by module. Again, the course is going to guide you through the 3 Ps that we talked about. First, very important module, Retirement Foundation Builder. Okay, this is where you'll become clear for yourself, right, on your goals and objectives. You have to understand what your goals and objectives are before you can successfully build and grow and manage your. There's an old saying that I think is very appropriate for what we're talking about. That is, goal without a plan is just a wish. If you don't have a plan in place, you're what good are having the goals to get there? So we want you to treat your retirement investing as a business. This is an acronym for the SMART goals. You may be familiar with those. We'll talk about those. and having you create a vision statement. What exactly are you looking to achieve in retirement? We'll shift gears then and we'll go to the profit portion of this. Identifying the right stocks, the best candidates, right? That honestly through VectorVest is not hard to do. What becomes difficult for most is how to manage them once they're in place. So you'll have this entire process, building and managing a growth portfolio. We'll do the same thing for a dividend portfolio. How to best identify a quality dividend stock. It's not just by finding the highest yielding stock. You need a good quality, mature company with a free cash flow that's going to continue to pay and grow those dividends. And then again, how do we manage that portfolio? In Module 4, we'll complete the provide transformation by teaching you actually two of our go-to option income trades. I talked about selling covered calls. We will touch on the ability to sell put options to generate income. Again, the idea is not here to make you an option expert. Modules 4 and 5 are designed to help you understand two of what I think are essential to building and growing your retirement portfolio: covered calls and protective puts. Well, again, we'll talk about selling puts, but they're essential to building and managing your portfolio. And the great thing is you don't have to worry about if you're new to options. In fact, I like it more if you're new to options, so we can teach you really the basic way for the very specific intent that we trade them. That is protection, insurance, and to generate income. Show you how the trade works, when to implement them, how to correctly set them up and manage them. And then finally, we come to preserve. I talked about during the presentation, we'll eliminate risk, right, with one trade, certainly mitigate risk tremendously, when to be defensive. We'll talk about protecting individual stocks as well as an overall portfolio. So these are what we call the modules. This is the learning portion where you learn how to do that within our program. Now, the Retirement Portfolio Transformation course is found in the VectorVest University. Let me just show you some of the bonuses, and the value is about $3,000, but you choose to do this, it's a lot less you're going to pay for that. Stay with me for just another minute. Bonus number 1. So I just showed you the 5 modules. They are recorded and archived in the VectorVest University. If you join us today for the course, what we do is we have 5 live mastery support sessions where we go in, we review each module one each week, and I'll bring up the calendar. And when we do that live while the market's open. We record it and archive it within the VectorVest University. So I know the question is going to come up: what if I can't make the live version of the mastery session? Well, don't worry. We record it, and later that day, early evening, it'll be, and again, I'll show you where to find it. I'll give you an example of it in the VectorVest University. So that's part of the bonus for signing up. We also have, I've mentioned a couple of times, our retirement coaching group that meets every Tuesday. Okay. What you're going to get here is we'll be recording those and putting them into the university so you can watch and see live. We've been doing this coaching group for about at least 6 years now. We meet every Tuesday for the last 6 years. We talk about portfolios that we're managing. We talk about income trades. We talk about protective puts, collar trades, which is just combining covered calls and puts. Okay, so you'll have access to that for 5 weeks as well. Now, the one thing that's not on here, if you're still in the room and you're interested and you're currently not a VectorVest subscriber, we will actually give you a trial period of 60 days to work with VectorVest as you're going through the modules, the mastery. Okay, so we'll have that available to you as well. It's not on the. So this is all for $595. We call it the early bird special. That expires today at 5 p.m. Eastern time. However, because you were kind enough to come here and join us today, I'm going to knock another $100 off that $595. Go to vectorvest.com/transform, and you can take advantage. That price is available for probably, I don't know, the next 20 minutes or half an hour. Like I said, John and I will continue to answer questions. He was kind enough to put that link into the chat box. So you can go right to that link right now and click on that link. Right. And when I do, I'll go ahead and take a second to show you where it brings you to. Takes you to the sign up. If you enroll today, this price is good for as long as we're on here today. $4.95 is the price. You can click here. You can scroll down. You can see exactly what, again, a recap of what the course offers through each module. All of that is there for you. Again, what we call the Act Now bonus saves you another $100. Come up here, click Purchase Course Now, and that will take you to the order form. If you are not a current subscriber, just put in your basic information and hit Submit, and it will walk you through the steps. Sign up for the course, and if you're not a subscriber, it will allow you to get the trial period for the 60 days that I mentioned earlier. If you are a current subscriber and you are interested in signing up for the course, simply click here and it will walk you through the process as well. So that's how you get there. Go ahead and type in there. Let me know if you have any issues getting in there while we're still here. Brian asked, what are the dates of the sessions? Okay, yeah, Brian, I'm going to get that for you. Remember, when you log into the course, before I go any further, and Brian, I'm going to bring the dates up right now, but before I go any further, take the course. After the course, I mean, you have to show that you've watched the videos at least and done the assignments and all. If you're not satisfied, we're confident enough in this course that we'll give you your money back. It's a 100% money back guarantee. If you're not satisfied, we'll give you the money back. First things I want to say is that once you sign up, you have access to the course for 1 full year. Not the VectorVest program. You would have to subscribe to that. You have access in the VectorVest University to the course for 1 full year. I'm going to fast forward for a second to the calendar dates because Brian asked, we're a little bit over our hour here. Brian, these are the dates. So the green boxes here are what again, the mastery sessions. These are live. What we do is we recap or review the module, and then we answer any and all questions during live market hours. This is Labor Day, so this one gets moved to Tuesday. Okay. Every Monday at noon Eastern time. Again, if you can't make the live sessions, later that day, it'll be in there. The blue boxes here are those live retirement coaching group sessions that will be recorded and moved into the university that same day as well. David has some good advice for you guys. David's been with us and has been with the course. He said, I'm going to share this with you guys. I'd like to remind people that we are no longer paying commissions. So take the money we save by not paying commissions and buy this course. David, thank you very much. I like that. I like that logic. But anyway, Brian, so this is when the live sessions are every Monday, except for that Labor Day week. We'll go to Tuesday at noon. And then these are the days where that live session will be. So remember, it's a risk-free trade. We say there's no such thing as a risk-free trade in the markets, but this one is, right? Take the trade. I want to go back to this slide right here because this is important to me. This one touches home. Ask yourself, how much is it costing you not to take the step to be able to manage and build and manage your retirement portfolio more concisely? So ask yourself, how much did it cost you if you were in the markets in 2000, 2008, 2018, 2020, 21? How much did it cost you during those timeframes? If it cost you then more than $495, then let's fix it. Let's make it so you don't have to experience 2008 or 20 or any of those drawdowns again without feeling comfortable and confident in what you do. That's That's the question I want you guys to ask yourself because it's never too late, right? They say the best time to plant an oak tree so you can enjoy the shade today was planted 20 years ago. What's the next best day? Plant that today, right? Today's the next. Never too late. So remember, it's a 100% money back guarantee. Go to the link there where I just went to, showed you the transformation page. And then one final thing before I go in and start taking any and all questions. Let me open this. Just want to show you real quick what the course what the course looks like. I keep mentioning VectorVest University. Let me show you exactly what it looks like. So this is the VectorVest University. This is mine, so it's pretty much full of everything here. But what you'll see once you join the course is scrolling down retirement portfolio transformation. I know I have all the these are the resources that you'll have available to you. Okay, these are the resources you have available. So you have a welcome video. We have remember I showed you the retirement foundation builder. It's broken down. We did it differently here. Instead of one long video, we have a bunch of shorter term videos. You can go step by step. We then have, by the way, I didn't mention we have a bonus module, trading credit spreads. Those are our option trades, but it's a free bonus module for you. Another way to generate income. Here's where you have access to the recordings of the coaching group. You'll have access from back in February until we record the new ones and put them in there. And then on our resource page, you have access to all of the slides. We have some checklists and cheat sheets that we talk about. So you have access to all of this. We even put them in both color and black and white if you want to print them out in color. You can download all of these pieces of information for you. Again, you have access to what I'm showing you here for one full year. All right. I'm going to answer a couple of questions that have come in here. If you have gone to the link to sign in, do me a favor, type in that you did, that you're in. I can tell you what to expect because if you did sign up, you will get immediate access to the course. Right? You'll get an email. Keep an eye out for an email. You'll get immediate access to what I just showed you, all of the modules and the recordings and the slides. You have access to that for a year. You'll also have access to a dedicated email bin where you can send us questions. And as I was saying earlier, during these sessions, right, you can email a question to us and we can share it in the live session. If you can't make the live session, we can visualize the answer for you here. And again, we'll certainly go back and answer the question via the. Okay. So if anyone's done that, I know that the link is working. Let me know if you're in or not. In the meantime, a couple of questions here. David, I see you talking about, yeah, David Paul's AMD, the Wyckoff spring. Fantastic. Anyway, I'll comment more on that. John said, John asked, does VectorVest have any indicator that differentiates ordinary versus qualified dividends? Not within our program, John. I mean, you can always go to news. You can, you'd have to Google that. I mean, we have a lot of dividend information that we give. I know I didn't touch on it as much. I can show you the search that we use. Share that with you. But in the retirement folder, it's called blue chip dividend payers. These are the type of stocks we built that portfolio on. And here we have a lot of dividend information. There's no one click in the VectorVest program to determine your question. We have dividend yield, growth, dividend payout. And then these are proprietary numbers, right? The dividend safety number on a 0 to 99 scale. We say anything above 50 helps you with that dividend payout ratio, right? You don't ever want to buy a stock. Well, sometimes some REITs or some master limited partnerships they're compelled to pay out most of their earnings. But what you don't want is a company that pays out more in a dividend than they earn, right? So the earnings yield at 6.38 and a dividend yield of 3.79, right? That's a favorable payout ratio, right? As long as they're not paying out more than they earn, unless it's a REIT, MLP. So we want dividend growth. We want dividend safety. That's what we look for. Dividend port. Okay, so hopefully that helps a little bit there. John Dwayne had a question here. Okay, yeah, Dwayne. Yep, Dwayne looks like you've been involved in some courses and have been in the VectorVest University. Um, yeah, if you can't do it now, Dwayne, we look forward to seeing you in the future. But appreciate you being part of VV Nation, as we call it. But good to have you, and maybe we'll see you next time. John had another question. What other limitations on selling puts in an IRA account? Um, John, again, it would depend on your broker. Times have changed since my Series 7 when covered calls were the only limit on an IRA account. Nowadays, most of the mainstream brokers, right, Ameritrade, Thinkorswim, which is part of Schwab now, which will soon combine with them, they allow you to do, a lot of the income trades, selling puts. In a retirement account, they'd have to be cash secured puts, but they allow you to sell puts. They allow you to sell credit spreads. So there's a lot of trades you can do. Um, in the mainstream brokers now, it wasn't always that way. But our bonus module will talk about put spreads. So yeah, selling puts in an IRA account will require what they call cash secured. They'll have to know you have the ability because you can't use margin. But it's still a great way if you've got cash. And we have built portfolios. And I'm going to start trying to build some again where if let's just say you have a portfolio of I just use some basic numbers, $100,000 portfolio that you're looking to have a maximum of 10 positions, meaning you'd put 10 grand into each position, right? Just the very basic portfolio setup. Well, what if instead of putting the 10 grand in, you just sold puts, right? And if you were assigned and bought the stock, fine, you were going to buy it anyway. You got to buy it at a much cheaper price until you populated a portfolio of 10 positions. What would be? Although selling credit spreads is also a great way to use the leverage of options. So much to do here, but we'll teach you how. Okay. All right. If there's any other comments, questions, concerns, anything I can help with before we wrap it up, I certainly do appreciate the time that you guys spent with us. If uh, if you're not in this time around, hopefully we'll see you next time. Trying to hang out for another minute or so. I just want to make sure I don't miss any questions that you guys might have. Once again, the VectorVest.com/. Go ahead and click there. Save an extra $100. That'll be good for another few minutes. Great, John says, great presentation. I'm going to sign up. Fantastic, John. Great to have you. Thank you. We do appreciate it. Just keep an eye out once you do sign up, John, for an email. Again, that email will give you all the information that you need. It'll give you the dedicated email link and everything that you need there. If you don't see it in a few minutes after signing up, make sure you check your spam or junk folder sometime there. But it should come just a few minutes after signing up. Great to have you, John. We look forward to seeing you at that first mastery session. You'll have time to go through as many modules as you'd like between. David, thank you. Appreciate all your comments. Thank you for taking the time. Henry, thank you. All right, with that, I'm going to go ahead and wrap it up. I don't see any new questions coming in. Again, John, thank you for signing up, and everyone else, thank you for taking the time. If we don't see you this time.